welcome everybody to 3 Minutes with Jay Bala, our portfolio manager at AIP Asset Management in Toronto. So Jay, what do we got this week?
The key benchmark you want to be looking at is the yield on the US 10-year treasury, which is at 2.6. And from a technical perspective, once it crosses over that line into sort of 2.55, 2.6, that signifies the end of a 35-year bull market in the bond market, which means for the last 35 years, if you had bought bonds, you were doing great because interest rates kept coming down. This will eventually break that curve. The next sort of threshold point is now 2.75. We are moving into a buyer's market in the bond market. Those that are patient and have cash reserves are going to do incredibly well in the next few months, so the next few years, as these interest rates continue to increase. In the last 12 days, the yield on the 10-year treasuries has actually gone up 30 basis points. So to put that into context, that means if you are holding these bonds, you would have lost 3% in market value in the last 3 days. Capital preservation should always be number one. Always have sufficient cash reserves that you can take advantage of opportunities such as this. And so I think, AIP and its investors are very well positioned to benefit from it.
As rates go up, what do you anticipate for the equity markets, or is it really going to be somewhat determined by the velocity of rate changes?
I would say both. As interest rates go up, in the short term, you'll probably have a rally in the equity market. In the longer term, people are going to make a tactical choice on, okay, do I want to earn, say, 5% on bonds, or do I want to risk my money in equity and get, say, a 2.5% dividend? And so there's a threshold. In the longer term, it will signify that, money will move from the equity markets into the bond markets, which will then result in sort of a sharp sell-off. It could rally 5%, but it could just as easily correct, 15, 20% as well, right? And that's why we're sort of gun shy on the equity markets at this point. We just don't think that's the play at this time. But obviously that time will come.
My last question, as always, what are you doing with your money, Jay?
Same place as always been. We're still about 50% cash, 50% in the hedge fund.
All right. Until next week, my friend, have a great week.
You too. Thank you.
Okay, thanks.